In the meantime, let's talk strategy. Our next guest says that stocks could continue to rally, but bonds could face more pressure. Joining us right now is Jim Paulsen. He is chief investment strategist at the Leuthold Group, and that makes sense to me. You think yields are going to continue to push higher, too, which makes sense if you think the economy is looking a little bit better. Yeah,
I think so, Becky. I think there's a lot of stuff going on with the trade agreement and presidential impeachment and all that stuff, but I think the underlying main thing driving things is just economic data is just getting better, turning out better than feared. And I think that's driving both yields and stock prices higher. People found out they're under allocated risk, and they've been too heavily orientated towards risk-off assets.
Because we all thought a recession.
That's right, the ghost of recession, which really peaked in August. We had kind of a fear crescendo in August, I think. And then since then, yields have bottomed out. Stock prices have bottomed out around the world, but also the leadership has really shifted away from low-vol investing in defensive sectors to, cyclical areas, to small-cap stocks, to international markets.
I was going to say, you don't think this is just a U.S. story. It looks like the data's good here, but it looks like the data is a little better in Europe and other places, too.
Yeah, I think it's going to be more leadership by international markets in the balance of this recovery. Not that we won't participate here, but I think the international markets have some catch-up to do. They're undervalued and underowned. But also, if every time in this recovery when we've had a global pickup, the international markets have benefited more than the United States.
But you attribute it to a lag effect for what central bankers have been orchestrating over there. You're the only person on the planet that thinks that might be working. When it's all said and done, we're going to say negative interest rates were actually a positive for rekindling growth in Europe? You're going to say that?
Well, I think that policy, Joe, economic policies have had less and less impact than they used to have.
But they still have one. We thought they didn't have any.
And I think I think it was a big assumption to make that they just suddenly stopped working. I think there's.
And you were waiting for it to, sooner or later things recover anyway. But you do it. You give.
Well, there's been about a 1-year lag between policy and when it has impact. Right. If you think about it, we tightened a lot between mid-17 to mid-18, and a year later we had a slowdown this year. But now we're about a year past the time when bond yields started collapsing all over the globe in October of 2018. And that about a year later, we're seeing a pickup now from the lagged impact of that.
How much room do European stocks have? I mean, their forward PE is only 13 and a half for European stocks. So, I mean, what you're saying makes sense. Low yields, low PEs. I don't understand how we're in that world. You're saying both are going to increase. How much?
Yeah. Well, I think that, the first thing is, it's interesting to me how long they've been outperforming already. European stocks have been outperforming for 2.5 months compared to the SPY here in the United States. So have Japanese stocks. Even the China ETF has matched the SPY in this country since May, despite the trade war. So some of this has already been going on without getting a lot of attention.
Right.
And I do think there's quite a bit. When you think of taking the German bund from plus 80 basis points in January of 18 to minus 80 almost just a few weeks ago, that's a lot of stimulus in terms of the long-term cost of capital in Europe. And I think the lagged impact of that could be quite dramatic. And we do have depressed multiples there and depressed earnings, and I think both could turn upward. They'll do that here a little bit, too, but there's just more room.
You think the dollar, even though rates are rising here, you think the dollar is going to weaken?
I do.
And that's going to be a boon for us here in terms of exports and multinationals.
Right. I think there's a few aspects. Our GDP growth rates held up a lot better as the global slowdown has occurred. Right. So the growth gap is
widened.
So
as they come back, then ours won't look quite as good.
Our yields have held up better, so that's widened. That diminishes the yield spread. And
so all these things are reversed.
And then inflation expectations, when that goes down, it really benefits the value of the dollar. But when inflation comes back up, it retards the value of the dollar. And I think that also starting to change. So all three forces, I think, are at work to bring the dollar down. If the dollar comes down, you bring commodity prices up. Yeah. You raise inflation expectations. You raise bond yields. You help energy, materials, industrials. Yeah. The rest of the world is much more composed by industrial, manufacturing, commodity-oriented enterprises than the United States. We're service-based. And so inflation benefits the rest of the world much more than it benefits us. And I think if not only you just get a weaker dollar, but you start to raise commodity prices, that's going to help emerging markets much more than it's going to help the United States.
You know, we were talking about yields, and when you're looking at almost 2% on the 10-year, is there a point that you start to get concerned about it, or because you think it's a signal of positive things, you think it's okay for quite a while?
I think right now it's a signal of positive things. Yeah. And I think it could go a little ways, Becky. Just for comparison, in March of 2018, we had a 22 times earnings multiple on trailing earnings that were rising. Mm-hmm. And we had almost a 3% 10-year treasury.
Right.
Today, we've got about a 20 multiple on trailing earnings with a 1.9% treasury. So there's quite a bit of room there to go back up. Particularly, we got this wall of what I call wall of worrywarts that have, held a lot more cash. And if you slowly convince them that the world's not going to end tomorrow, that's a lot more buying power.
Are they chasing the train right now?
I think it's helping, yeah. I think part of that is just, they haven't really turned bullish, but if they're just less bearish, that brings a lot more investable capital to the market. And I still think there's room. I mean, I really think before this ends, we're going to see the 10-year treasury above 3% again.
And it'll still be okay, probably.
Maybe. We'll just see how that plays out,
Around 3. I mean, we don't want... We have this fear of what happened in Japan for 20 years.
Yeah.
Inflation, I think that would be a positive, even if we did go above 2.5 or whatever, because we finally...
To me, the difference between us and Japan today and what happened in Japan...
We still have babies.
Japan, yeah, that's true, too. We have demographics. Yeah. But Japan went into a deflationary abyss when the rest of the world wasn't anywhere as close to that.
Right.
And in fact, at that time, we kind of liked that they went into the deflation abyss. They were coming over and buying up our golf courses, if you remember.
30 Rock. Yeah.
Right. We got tired of that. So we were kind of enjoying their plight. No one was there to help them. But today, the entire world's in the same boat. And look at what everyone's doing. They're all massively easing policy. And I think that the result's going to be not runaway inflation, but I think we're going to have a revival in inflation.
So, meaning the good news eventually becomes bad news with all of this massive easing?
I think so, but there's a lot of good news before it becomes bad news, maybe. In other words, most every recovery we've had in post-war history, Becky, has ended in some sense of overheat hitting it.
The bottom line is buy right now.
I think so. I think so. There's still some good things we could do here, too. We're starting to have productivity pick up without much discussion. We're having the labor force participation rate pick up. We're having a household formation boom with millennials. We've got a really strong consumer balance sheet with positive personal savings we haven't used up yet. We've got a manufacturing session we could revive. It's odd to have that much capacity left this late in the cycle.